What's going on, everyone? 𝐒𝐮𝐫𝐞𝐬 here, and today we're going to be exploring the spectrum of investment mandates that in my practice we actually oversee for clients across North America. Now we're going to examine factor investing, the advantages and disadvantages of each of these approaches, and markets in which each investment model we run performs well, and which types of markets they actually end up not performing so well. So whether you're a current client or you're looking at us as a potential solution for your financial needs, this video really aims to provide you a quick overview on our investment process and how we manage various investment mandates across Canada and the United States, and really getting into our head on how we think and how we make decisions. So stay tuned. Alright, welcome back. So let's jump right in here. Now, my team implements what is known as factor-based investing. Now, this is a type of investment strategy that attempts to select investments based on specific characteristics or factors that we believe that are associated with higher potential returns. Now, the idea behind factor investing is that we're targeting investments with specific characteristics. Investors can attempt to systematically earn higher returns over a longer period of time compared to a traditional index or index-based investing. Now, this is because certain factors have historically demonstrated persistent outperformance over time, and investors can actually exploit these factors to improve their portfolio returns. Now, the 7 most common factors include value. Now, this factor aims to identify investments that have low prices relative to their fundamental value. Now, for example, if we identify investments with solid financials, a strong brand, a competitive position in the market in which those stock prices have been impacted by temporary factors, for example, like market fluctuations, industry headwinds, or negative news coverage. An investor using value investing would buy shares in a company at a discounted price, hold on to them until the market ultimately recognizes the true value of that company, resulting in higher stock prices and potential profits. Now, another style is referred to as small size, investing in smaller high growth companies. Now, this could mean investing in a relatively small company that is unknown to most. As they continue to grow, more find out about this opportunity and then start to pile in. Now, this compounding effect is larger for smaller companies than for potentially larger firms, as their ability to grow is much greater. Now, another factor is known as momentum, which identifies investments with upward price trends. Basically, investors using momentum will aim to buy high and sell higher, riding the current wave of positive price movement. Another style is known as low volatility. This looks to invest in stable, low risk stocks. Now, this generally is a more defensive strategy which looks for investments within a consistent return stream. Another very popular one is known as dividend yield, which aims to identify investments that have higher than average dividends and or income streams. Now, these factors rely on securities that constantly spit out income, which can either be lived off of or reinvested. Another major screener factor is known as quality, which invests in financially healthy securities. Unprofitable investments are excluded when using this factor. And the thesis here is that better run firms in the long run should be rewarded with a high share price relatively compared to their less well-run counterparts. Now, another major factor that is used is known as growth, which invests in securities with higher than average growth metrics, such as historical earnings and or sales. Now, these types of investments may have high price to earnings ratios, or PE ratios, meaning that their current stock price is relatively high compared to its earnings per share. That being said, investors believe that this company's revenue growth potential justifies its current valuation and sees the potential opportunity for outsized returns. Now, we focus on utilizing 4 of these factors across a lot of my portfolios in my practice. Now, first off, I just want to mention and quickly cover the factor styles that I actually don't use in my practice. So these ones actually include low volatility or low vol, small size, and value. Now, moving on to factors that we actually do implement, let's start off with the quality factor. Now, this is evident in every one of our model portfolios. The quality factor, which places emphasis on the financial health, is one of the first considerations really that we make when deciding what investments we use. Typically, unprofitable, unstable, and low growth investments are excluded from our portfolios. Screening for these types of investments is actually the first thing that we do for every one of our model portfolios. The next one that we would look at is the dividend factor, which can be found in a lot of our income models, which is designed to produce a higher level of income for a relatively risk-averse clientele. Now, implementing our income model, screening investments for above average dividend or income streams, which are both stable and sustainable, can provide investors with consistent cash flow throughout the year. Now, our income model is most suitable for retirees and those who have generally risk-averse methodologies with their investments. Now, growth factors can actually also be found within our North American equity and our sustainable equity models, both of which focus on investing directly in Canadian and US stocks. When constructing these two models, we actually start by identifying stocks that are expected to grow in sales, earnings, and margins at rates above their competitors. Now, our sustainable model takes this a step further by overlaying a lot of ESG-based screenings, including faith-based investing screens. Now, these faith-based investment screens would typically exclude securities which would be considered to be in the sin industries, which would include alcohol, conventional financial services, gambling, tobacco, pornography, and other entertainment industries which a lot of groups of people would prefer to not be a part of. Now, with some of these investing strategies, it's also important to exclude stocks with total debts less than 33% of their equity, accounts receivable of less than 51% of their assets. Now, lastly, the momentum factor can actually be found in both of our balanced ETF and North American equity models. Compared to other factors, momentum provides investors with a more hands-on approach to portfolio construction. So that way we'll be able to spend a bit more time unpacking this factor. Momentum investing is a popular investment strategy that involves buying securities that have exhibited strong past performance with the expectation that they will continue to perform well in the future. Now, this approach is based on the belief that stocks have been trending upwards will typically continue to do so, and that those that have been trending downwards will likely continue to decline. Now, one of the key concepts of this style investing is identifying momentum investments, which actually can be done by using technical analysis tools such as moving averages, relative strength indicators, and trend lines. Now, these tools help to identify securities that have been performing well over a certain time period, such as the past 3 or 6 months, and have a higher likelihood of continuing to do so. Now, once these momentum investments have actually been identified, we typically hold on to them for a relatively short period of time, anywhere between 1 to 3 months before selling them for a potential profit. Now, this approach is often characterized as a buy high and sell higher strategy, as momentum investors look to capitalize on upward momentum of a stock. It's important to note that momentum investing is considered a higher risk, higher reward strategy. Now, while it can provide significant returns in a shorter period of time, it can also be quite volatile and may lead to substantial losses if the security momentum turns downward. Now, in comparison with value investing, which focuses on finding undervalued securities, momentum investing is considered to be a more speculative approach. In value investing, investors are looking for investments that are undervalued based off of financial metrics like price to earnings ratios, while momentum investors really are looking for stocks that have been performing well in the past and assuming they'll likely continue doing so in the future. Overall, momentum investing can be a powerful tool for those looking to capitalize on short-term market trends, but it really should be approached with caution and a thorough understanding of the associated risks. It's important to have a well-diversified portfolio and to not put all your eggs in one basket. Now, moving forward, let's dive into the pros and cons of each of our investment models. Starting off with our income model, which is actually offered in both the US dollar and Canadian currencies. This is a buy and hold model that typically invests in real estate, both government and corporate bonds, dividend-paying securities, and other various alternatives. Now, these investments can be done directly through individual securities or pooled investments like either an exchange-traded fund or a mutual fund. Now, this model is rebalanced annually with the main objective of providing income. Therefore, it tends to invest in securities that pay a dividend or has an interest or an income stream attached to it. Now, because of this, this model tends to perform well when interest rates are either stable or in a decline. Additionally, when invested in securities raise their dividend, this model will actually react favorably. Now, on the flip side, when rates are on the rise, like we saw last year, for example, or when dividends get cut, the model will actually tend to underperform its benchmark relatively. Now, our second buy and hold strategy is known as our all-weather model. Once again, this model is provide investors with both Canadian and US currencies, both on a balanced and growth basis. Our all-weather models also give investors global stock and bond market exposure through the use of low-cost ETFs. Now, these models are designed to more or less match the returns of balanced and growth benchmarks, Our all-weather models attempt to do this in a much more diversified and lower risk manner. Now, this model performs well when investors have longer term horizon and when stock and bond markets are on a positive trend, and poorly, unfortunately, when they are on a decline. Our last buy and hold strategy is our sustainable equity model. Now, this one invests directly in individual stocks across North America, and this model performs well when stock markets are advancing and when the individual securities that we invest in receive an upgrade from equity analysts, for example. Now, on the other side of things, conversely, when an invested stock receives a downgrade or the general market is in a decline, this model will tend to underperform. Each of the major sectors are evenly represented in this model, meaning we equal weight each of the stocks in the portfolio, so that the risk between the securities and sectors remain fairly even. The next two models are our North American equity and our balanced ETF model, which both use momentum factors as their primary investment strategy. Now, any momentum model identifying positive and negative trending markets is really the main crux or imperative. Therefore, stock and bond markets remain in stable, predictable uptrend. This model will perform extremely well. Similarly, when the markets do the opposite and are in decline, the model identifies this and will sell that security if owned or avoid investing in if we don't already own it. Identifying which investments not to buy is almost as important as identifying the ones to buy. Where this model tends to struggle is in choppy markets where they flip-flop month to month, going up and down and then up and down again. This makes identifying these trends nearly impossible. Well, there you have it, a detailed summary of a lot of our investment models and explanation of factor investing and the advantages and disadvantages of each portfolio. And ultimately the markets in which each investment strategy that we run would perform well in and which types of markets they tend to not perform well in. I want to thank you for watching to the end of this video. If you appreciate the content that I'm creating, please consider hitting that like and subscribe button, as it really does help out the channel. The bell icon will keep you notified the next time I upload a new video as well. I'm also going to put my contact details at the end of this video. If you have any questions about your own individual situation or you have more questions about our portfolios, please feel free to drop me a line. Until next time, please stay safe out there. Bye for now.